Welcome, everyone. My guest today is Managing Editor James Kleimann to talk about Jay Farner leaving Rocket, Joe Tyrrell leaving ICE, Zillow earnings, and more. James, welcome back to the podcast.
Hey, good to be back. Thanks, Sarah.
Great to have you back. As always, we talk about what's happening, some of the reporting we're doing in the newsroom, the HousingWire newsroom, Real Trends, and Reverse Mortgage Daily newsrooms, of which you oversee all of that. So we've got lots of big stuff. Let's start with Jay Farner leaving Rocket Companies.
Yeah. So Jay Farner leaving Rocket Companies, and he's going to be replaced, at least in the interim, by his predecessor, Bill Emerson. And, the lender is looking for a permanent replacement both internally and externally. And I think the major takeaway here is Jay Farner exiting Rocket has caught a lot of people by surprise. For starters, he's been the public face of Rocket/Quicken for a number of years, really, since Dan Gilbert stepped back. And he's only 49 years old. And it's frankly unusual to see an executive at that level, at that age, voluntarily leave a job that is so prominent. And Jay is admired by a lot of people in the industry for really pushing very innovative marketing ideas. Push button, get mortgage, right? And at heart, he's a marketing guy. And in some ways, I think it's fair to say he put mortgage back on the map for the American consumer following the housing crisis of '08. So he's a major name, a big figure in this industry. And while being the head of marketing is an important role at pretty much any mortgage lender, I think it's much more important. It's a much more critical role at a company like Rocket. And so if you think of it this way, Rocket is mostly a consumer direct lender. And so they depend on brand recognition to do business at scale and to capture profits. And so it's all about brand recognition. And it's worked. Like if Sarah, if you went down to Main Street USA and you ask people to name a mortgage lender that isn't their bank, like Wells Fargo, JP Morgan Chase, dollars to donuts, they're going to name Rocket Mortgage. And I think Jay Farner is a big reason that Rocket has grown from doing about, 30 billion in originations in 2011 to about almost 90 billion in 2017. And they even grew much bigger than that over the pandemic, and until very recently, this was the biggest mortgage lender in America. And that's not by accident. But of course, nothing lasts forever. And after 27 years, Jay Farner is retiring, and it's effective on June 1st. And, the retirement comes just a few weeks before Rocket reports its fourth quarter earnings. And we've spoken to a lot of analysts over the last week, and pretty much all of them believe that Rocket is going to show declining revenue, shrinking origination volume, and probably a financial loss in the fourth quarter. And it's not like the first quarter looks any better. Mortgage rates are still in the mid sixes, and there's very little inventory. And this is not a business with a lot of sentiment, there's just not at that level. And so Jay is the head of a shrinking business that currently is not profitable and probably won't be for a few more quarters. And this is a publicly traded company. Investors, they don't like that. So I think there's upheaval, there's uncertainty, and it's a really competitive mortgage market. So, I think also, having said all of that, it's also worth noting that Jay Farner is giving up his seat on the board. And Bill Emerson is going to be taking both the seat on the board and running Rocket Companies, which of course is more than just Rocket Mortgage, right? It has a title arm, it has a slew of different businesses. But when you think about Rocket, something like 90% of the revenue, the business is mortgage. So overall, I think this is a pretty unusual move, especially for Rocket. And I'm really curious to see how it all unfolds over the next few weeks.
You talk about the fact that, their fourth quarter earnings are going to be down, but that's not unusual. I mean,
No.
We're in a really tough mortgage environment. I'm not sure the CEO of any mortgage company can, make a difference there. I mean, of course they do great work, but I'm just saying you can only,
Sure.
Work with what you're dealt, and no one is being dealt a great hand right now.
Right. I think it's also worth pointing out that Rocket is not a reactionary kind of business. They always talk about how they're in this for the life cycle of the consumer, and they don't think quarter to quarter, that they are very much a big picture, long lens kind of company. And any CEO in a mortgage company right now is, I don't know how you could ever feel comfortable in the environment that we're in. And what's happening at Rocket is by no means strange. You find me another 10 mortgage lenders right now that are making money. It's not easy right now. It is definitely not easy. What I think is most unusual about this is that Jay Farner, who has spent most of his adult life at Rocket Mortgage and came up with a lot of other executives, is breaking clean entirely from the company. And this is a company that promotes from within and typically has succession plans. And there's obviously no succession plan here. And they don't hire businesses, executives from other businesses. There are no other lenders whose CEOs are running top divisions of Rocket. It doesn't happen. Their own people climb up to the C-suite, and so almost everything is internal. And retiring executives at Rocket, they historically stay in orbit. They'll work on charity initiatives. They'll work at the holding company or the parent company or side ventures, whatever, but they're always kind of in the background. And so I don't know why Jay Farner is leaving. If you look at the SEC filings, it doesn't say that there is any discord or anything like that. And we don't have any reporting that suggests that there's another reason aside from he decided that this was time to leave. But I will say that given all the circumstances, what is happening is definitely unusual.
I think that's a really good point. Even the SEC filing says Mr. Farner's retirement from the board was not because of a disagreement with the company. So again, really unusual. We'll look to see who they replace him with long term and where he might jump next. I mean, he's retired, but
yeah, I mean, look, Jay made his money. I don't think anyone's going to be crying for a charity case here. He made something like $50 million in 2020. He's definitely okay financially.
right.
And I think, it's interesting that this also presents an opportunity for some internal candidates. As I said, Rocket historically does things from within. And I think it's also telling that Bob Walters, who's currently running the mortgage company, didn't get the seat on the board or the interim promotion. They decided to go back and choose Bill Emerson, who was Jay's predecessor and ran the lender for a few years, a little less than a decade ago. And Rocket's also seen a few key departures in the C-suite over the last year or so. You might remember that Julie Booth and Angela Vitale both retired. So this could usher in a period of kind of a new guard of younger executives moving up the ladder in Rocket. So like a Tim Berkmeyer, the president of Rocket Mortgage, very well respected in the organization. Casey Herbis runs marketing for Rocket. That's traditionally a good path upward. We know Austin Yemick, of course. He's moved over from running wholesale to becoming the chief revenue officer, and he's very highly thought of at Rocket, but probably doesn't have the experience to be given the CEO role, but is certainly moving upward. So there's a lot going on here, and it means there are going to be additional moves. Like Jay Farner leaving is only the first step. There's going to be, I think, a lot more that happens over the next few months, and investors are going to want to know who's steering the ship.
I do think Bill Emerson is a good, you can see why that gives investors, lots of peace of mind, right? He's done it before. He's very well respected. And like you said, stayed in the orbit. So definitely, not like, oh, it's the sky's falling, but it's going to be interesting to see what happens. I mean, they were the number one overall lender up until the third quarter. Huge deal here. So we will keep looking, and we have all sorts of things going on, differently. It's not a lender, but ICE Mortgage Technology named Tim Bowler as president. So he's going to succeed Joe Tyrrell, who has been there since 2002. And to my mind is the face of, it was Ellie Mae and then ICE, right? Like Joe Tyrrell is right in there. So it's going to be interesting to see a change over there. Bowler has a background. Obviously he oversaw global benchmarks, including the ICE swaps. When he joined ICE in 2017 to lead IBA. He's done a lot of things, so definitely someone who's very well qualified. But interesting to see Joe step aside there.
Yeah, and it makes you wonder what's going on with the merger, right? And just recently, we saw the news that Black Knight is looking to sell its LOS for, I think it was something like they valued it at $400 million. And there's a lot of speculation as to, is this because they have some sort of an agreement with the FTC, or because they're trying to get ahead of the FTC saying you haven't done enough, this is clearly monopolistic. And, Encompass is still the big one. ICE's Encompass is something like, depending on who you ask, like between 40 and 50% of the market. Black Knight only has about 10 to 15% in terms of the LOS, but that is definitely, when you talk to the opponents of the merger, it comes up a lot. And so it looks like they're trying to get ahead of it, but we just don't know where things are in the process and why Joe is leaving and where he goes, right? I would love to know. Joe, call us. What's up, man?
We would love to know that this is a guy who's done some amazing things and, has a great background as well. Some more information on Bowler. He was a managing director in the financial institutions group at Goldman Sachs. He was counselor to former U.S. Treasury Secretary Jack Lew and acting assistant secretary for financial stability. So, seems like a guy who can step in and do this, but definitely I agree with you that it does raise questions about what's going on with the merger and when we will know the answer to that.
And Black Knight also has had a few changes on their board. Some folks who are not, running again for seats. So it's going to be, I think, a really busy spring if you're at Black Knight or if you're at ICE. So I know a lot of people want to see an answer by the summer. So we're going to keep tabs on that, certainly.
So many interesting things going on. What else would you like to talk about? I know we've got some Zillow news, right?
So Zillow, of course, is back in the news. They had their fourth quarter earnings on Wednesday, and they were better than expected. I think a lot of people thought that Zillow was going to fall really hard given just the slowness of the housing market and really kind of how it's positioned post iBuying. And they surprised a lot of people. And when I think about Zillow, I don't really think about it in terms of dollars and cents anymore. I think about it in terms of how much use are their products getting right now. And so I think there are a few really interesting nuggets here. So in the fourth quarter earnings call, Rich Barton, the CEO, talked a lot about Zillow returning to its core advertising sales business, which, of course, as you know, is really heavily based on real estate agent advertising. And they've also been promoting this housing super app that they've talked. It's vague, but they've talked a lot about it at the same time over the past 6 months. And what's really telling here is Zillow has these industry-wide forecasts that, basically range from a major problem in the housing market, which of course is a major problem from Zillow, to a biggish bump. And Zillow's outlook calls for the industry transaction dollars to decline by about 35% from a year earlier in the first quarter. And when you look at what this actually means for Zillow in terms of product usage, visits to their apps and websites were down about 5% year over year in the fourth quarter. And so this is a sign that consumer interest, of course, is waning given how difficult the economy is for home buying. And tellingly, agents are pulling back on spending as well. And so for the first quarter, Zillow said its agent ads business could drop in terms of sales by as much as 28% year over year. And so when you couple those expected declines with, investments in new products and, just all of the various changes that as a corporation Zillow has to deal with, I think there are probably going to be some rough quarters ahead. And they're building a housing super app when nobody's really buying houses right now. So I don't know about the strength of that overall strategy and what this means for companies that are less capitalized than Zillow.
Well, I would say, though, that, the super app, again, it's if you're selling less homes, then you want more of the piece of the pie of everything that goes into that, including like the moving expenses or the,
Yep.
whatever parts of those. And we've seen so many companies be like, we want to have the end-to-end experience, or, not just like you bought the house, but like, okay, how are you going to maintain the house and, put all your docs with us and let us, connect you to when you want to do renovations and just all these other things. So in some ways you can say, if the pie is smaller, you want a bigger piece of whatever that pie is.
Absolutely. And they're still standing, and iBuying is going through a very, very difficult time right now. I mean, arguably more than they. I think they were fortunate to get out when they did. Not that they covered themselves in glory here, but imagine trying to sell 10,000 homes in this market right now. I mean, it's rough, and part of that business model is to make money. You also need to be buying, and so if you look at sort of the main competitor, former competitor, I guess. They're now allies in a weird way. Open Door, they still had to buy 1,000 homes in the last quarter, and these are not homes at deep discounts, And it's, um, I think there's still major questions about what that, people talk about like Web 2.0, 3.0. What is housing 3.0? How digital does it get? How sticky can a platform or a service provider like an Open Door or a Zillow be in terms of realizing, even fractional profits on the moving company getting a piece of the action, the agent, the advertising, the title, maybe even in the future, right? Like you could see uh, some elements of a housing super app actually becoming something, but will they run out of time? Like, can you get enough traction before um, you know there's enough of a business to actually fight for? So I don't know. It's not like inventory is going to be getting any better for a while. We need to get back to this time and time again because it's not improving.
No, it's not. I do think that the fact that Open Door, bought 1,000 houses in some ways, you can think that that's going to be challenging. On the other hand, in a low inventory environment, maybe there's a way that works out well for them, right? It all depends on what you bought it for and what you can sell it for and how long you're holding that. But I think that's interesting. And the other thing that from this reporting that we did on Zillow was the fact that the Zillow Home Loans has really shown some promise there and jumped as far as, they looked at one test market of Raleigh, right? In Q3 2022, there was a 15% adoption rate of Zillow Home Loans in the products test market of Raleigh. In Q4, it jumped to 20%. And you do think, you talk about making stuff easy. If you're looking at a home, you're like, I want this home. Not only can you get the premier agent, but you can be like, yeah, let's just go through, Zillow Home Loans. You can see how that could be easy for everybody.
Yeah, and it's important to note that they were incentivized to do it. Like they actually realized a cash savings by having this consolidated product. If it had been, say, a year prior or a year and a half prior when this company was still doing iBuying and trying to pair, a service like mortgage, it didn't work. People just didn't use their mortgage lender. But now if you can make the numbers work for the consumer, yeah, I mean, it's a lot easier to just go with the same company for everything, right? I mean, you should have economies of scale that make it a much smoother, flatter, easier process for the consumer. And when we think about the real estate transaction right now, it's still, there are too many people. There are just way too many people. It's too complicated, and there's no reason, outside of just this is structurally how homeownership has developed, and I think that there is a way to cut through some of that noise, but there's no model that has proven successful. So think about the discount brokerages that decide to cut the agent out. Where are they? Where's Purple Bricks these days, right? A lot of them are embracing the traditional models again because they have to. They cannot stay in business. Homeowners just weren't ready, or they couldn't get enough things easy enough at scale for people to adopt it. And then it's a house of cards and things fall. Zillow does have, I think, the consumer, not power, but people know Zillow as just a household, a Pepsi, or it's a brand that transcends what they actually make money doing. And so, just from purely that standpoint, I think they have a chance to really change the way we buy and sell homes and who makes money along the way when that transaction does happen. But I don't think they're particularly close either. This might take a very long time if it ever happens.
It is interesting to me because it's the same sort of thing as Rocket, where it's like, boy, I mean, you talk about consumer awareness. You could not get better than Rocket or Zillow. I mean,
Yeah,
Zillow and Zillow is what people do. There's a whole bunch of people who just surf it for fun, which you think, oh,
right.
that's
It's a
not great
verb.
for. You're right. I'm going to Zillow. Zillow Gone Wild, as I told you about, is something
Yes.
that I look at on a
Great
regular
account.
basis. But it's just one of those things where you're like, to me, that's where so much of this juice is, because when you go to buy a house, people do not know. People do not know how to shop for a lender. I think about all of the incredible work that the industry did. So to implement TRID, right, back in the
Hmm.
day, 2015, whatever it was.
Sure.
And the whole point of that was to make sure that, well, first of all, that people knew, what was going to be on the closing disclosure. They had enough time to know what they were getting into and review those things. But it was also to give them the opportunity to do shopping. But I mean, it is such a painful process. Who wants to do shopping? If you found someone and you got a good rate, you're like, okay, let's do it. And of course, in the last couple of years, if you waited on a house to go shopping for your mortgage lender, you might have just missed out on the house anyway. So I just think that this sort of thing where, I could find the house through one place and then, do have the real estate agent and the mortgage through that same place, that really goes against the idea of like, oh, competition or like shopping around. But I don't think people were doing that anyway.
No, I don't think so either. And there's this idea that transactions should be smooth if you eliminate some of these bureaucratic frictions. But when I think back to my experience buying a home and looking for a home, the thing that slowed everything up all the time was just the back and forth with the seller, and just how long I'm like, okay, well, we have this fireplace, it's damaged, can we get a credit for that, or will you reduce this? And it's just like everything that took forever was just in sort of the human element of it. And I don't know how, a company could really flatten the negotiation part of it. And that's tricky. I mean, yes, you can definitely, closings, I think, can be a heck of a lot faster than they are. I think the lending process itself shouldn't be 30 days. Unless you have
Right.
a really, really weird circumstance right now, I don't think it should be 30 days. I think most processes could be done in 2 weeks. And a lot of lenders can and do that. It's not certainly the standard, but most mortgage lenders out there right now, I think, could do it alone in 2 weeks. Will that become standard anytime soon? I mean, we saw Better really trying to make an attempt at that, and they're going to get caught in the trade web as well, right? They're trying to create a process by which someone can basically get a mortgage approval letter and then close in a few days. You can't do that based on current regulations, but the technology is there. It's really just we have these structural barriers to getting a process smooth enough where a consumer feels comfortable without having like an army of advisors and people to work with. So I think Zillow is at least a decade away from truly transforming the way in which we buy and sell homes. And I don't think anyone else is particularly close, personally.
Wow. Okay. Well, we're going to have to revisit that as we go along and
10
see.
years, Sarah. We're going to talk
10
again
years. Mark it.
in 2020, 2033. Mark it on your calendar.
Oh my gosh. I feel old already just thinking about that date.
Same.
I do think it's a really interesting thing to bring up the regulatory part of this because, people right? When I buy a house, I want it to be as seamless as Amazon delivering something to my house, all the other kind of things we could talk about that are so seamless. But the fact is that there are so many things here that have to be taken into account, which we on other shows and in other stories talk about that. And we know are really important. We don't, you don't want any sort of racial bias in the system. You want to make sure that it's a level playing field and that there's fair lending. And then, there's just so many things about it that like you don't have to think about when you're ordering something off Amazon. It's like, yeah, go buy it. So I do think that we still have a pretty big disconnect between what consumers really want and what they can get.
100%. Couldn't agree more.
Well, there you go. What are we reporting on in the next couple of days? What do we have coming up that you would tell our listeners to look out for?
So Redfin is announcing their fourth quarter results later. Today's Thursday. We're recording this on a Thursday afternoon, and that's going to be one to watch. Of course, Opendoor, Zillow also are going to be of interest, and then we're also going to, on the mortgage side, going to have quite a few earnings calls over the next 2 weeks. So Rocket, UWM, they're going to be going public with their results from the fourth quarter. I think there are going to be a lot of eyeballs on that. Home Point, another good sized lender, is going to have their results in the next few weeks as well. So we're going to be keeping track of all that. And there's always something, Sarah. We don't get a moment's peace here.
We don't. Yeah. So there's so much happening. Your newsroom's doing an amazing job covering it across all these brands, and we will continue to look for that. So James, thanks for being on.
Cool. Thanks for having me, Sarah.